I just got off the phone with an owner who wants to understand the SoCal Industrial market. And I do so many calls like this every week. I thought I'd turn the camera on and just ramble, no notes, ramble about the SoCal Industrial market to explain some of the dynamics that we're seeing right now. Um, because if you don't know, it's kind of interesting. So, SoCal Industrial, it's like a 1.8, 1.9, maybe 2 billion square foot market, depending on whether or not we're counting San Diego. But starting at the ports in LA and Long Beach, going through infill, Los Angeles and Orange County, out to Inland Empire, there's a bunch of different submarkets. I always joke that you could drive like 7 minutes in any direction and you're in a different submarket with different market dynamics. Generally speaking, in the infill markets of LA and Orange County, we do most of our work in and around Orange County. The markets are holding up pretty good from a supply standpoint. So we're kind of barbelled here in Orange County with one end is the South Bay market, the other end on the other side of us is the Inland Empire, and both of those markets are very dependent on one industry type, one tenant type, and that is 3PL activity. It's not to say that's the only tenant type, but it's very heavily influenced by those. Where we're not as much dependent on that industry or one industry in the infill markets in Orange County, we have a very diverse tenant mix. So we've got defense companies, aerospace companies, we got lots of manufacturers, food and beverage, a lot of headquarters users. We've got high tech, medical device, and other high tech users. The interesting thing about Orange County, if you split it, just say you split it down the middle and call it North Orange County, South Orange County. There's a central as well, but just split it in the middle. There's a pretty big disparity between North Orange County and South in the fact that the South Orange County areas around Irvine, has a real high-end labor base that a lot of people want to get access to. So it also has less available industrial space and less available developable land for it. So that is one interesting dynamic that's in play. Um, Overall, on the supply side, we're sitting pretty good. We were 3.1% vacancy rate at the end of the fourth quarter. The first quarter numbers are just about fully baked, and it looks like we're going to actually tick down on our vacancy. Like it's going to come down to 3%, which is kind of wild. So we're doing fine on the supply side. It's the demand side of the equation that we are really lacking. And so I would say you would define this market from the last 2.5 years as just an utter lack of tenant demand. And that's likely for two reasons. One, tenants in 2022 and 2021 just leased a lot of space. They just did. And their bellies were full. And you don't need to lease a brand new building every year or every other year if you're corporate America. And then two, it's really hard for tenants to make long-term real estate decisions when the macroeconomic outlook is so murky. It's like nobody knows what's happening. If you were going to say we're going to have the worst economic crash that we've ever seen, or we're going to have a soft landing, I think most people feel like both of those scenarios are somewhat realistic and somewhat on the table. So there's a lot of murkiness there on the tenant side. Overall, on the supply side, we're doing well, but the other dynamic in Orange County is we've got institutional owners that got into the market maybe more recently, and then we've got real long-term owners, private owners that have held these assets for a long time. And their basis is super low, which means their taxes are super low. And here in California, your taxes are assessed upon sale. So if you bought it for $30 a square foot, that's the assessed value. Compared to if you bought it for $500 a square foot, your taxes are ridiculously higher. So we've got monthly operating expenses ranging from 10 cents a square foot for some owners all the way up to 60 cents a square foot for other owners. These legacy owners can afford to do any sort of lease deal they want, and it still may even be one of the highest rents they've ever gotten. Institutional owners, groups that came in the last 3, 4, 5 years, they've got to hit a certain hurdle. Like they bought an asset, they underwrote a rent, and they've got to hit that rent, and it's really hard for them to hit right now. The good news is we just need a little bit of leasing activity. If we lease 10 or 12 of our biggest vacancies in Orange County, we'll get back down to like 2%. So it's overall a really strong market that has been real sleepy lately. I've hit the 5-minute mark, so I'm turning this off.